Reporting on internal controls to shareholders is a fundamental element of corporate governance because it enhances transparency, accountability, and investor confidence by demonstrating that the board of directors has established and maintained effective systems for managing organizational risk and safeguarding shareholder assets. Modern governance frameworks recognize that shareholders, as providers of risk capital, require assurance that directors are exercising proper stewardship over company resources through appropriate internal control and risk management systems. Within the program, reporting on internal controls forms an important component of board accountability, ensuring that shareholders receive sufficient information to evaluate the effectiveness of governance arrangements and the organization's ability to manage strategic, operational, financial, and compliance risks. Such reporting strengthens the relationship between the board and shareholders while reducing information asymmetry and agency conflicts through greater corporate transparency. The responsibility for reporting on internal controls rests primarily with the board of directors, which has ultimate accountability for establishing and maintaining a sound system of internal control. Directors are expected to ensure that internal controls are designed to safeguard organizational assets, support reliable financial reporting, promote operational efficiency, and ensure compliance with legal and regulatory requirements. However, governance responsibility extends beyond establishing controls. Directors must also communicate their effectiveness to shareholders through appropriate corporate reporting mechanisms. Consequently, internal control reporting has evolved from a purely compliance-oriented exercise into a strategic governance process that demonstrates responsible leadership, risk awareness, and long-term stewardship of shareholder resources. A key principle underlying internal control reporting is that shareholders have the right to know whether the organization's internal controls are sufficient to safeguard their investment. Since shareholders delegate management authority to directors and executive management, they rely upon corporate reporting to evaluate whether appropriate governance arrangements exist to protect company assets and ensure sustainable performance. Internal control disclosures therefore provide assurance that risks are being identified, monitored, and managed appropriately while supporting informed investment decisions and shareholder oversight. Transparent reporting also strengthens market confidence by demonstrating that governance systems operate effectively and that directors remain accountable for organizational risk management. The framework emphasizes that the board should conduct an annual review of the organization's internal control systems in order to provide shareholders with the necessary information regarding governance effectiveness. This annual assessment should evaluate whether internal controls continue to operate effectively in light of changing organizational risks, strategic developments, technological changes, regulatory requirements, and external environmental conditions. Continuous review ensures that control systems remain appropriate and responsive rather than static or outdated. By conducting regular evaluations, the board demonstrates its commitment to continuous governance improvement and effective risk management while fulfilling its stewardship obligations to shareholders. An important aspect of this reporting process concerns the scope of the internal control review. According to the framework, the annual review should cover all material controls and risk management systems operating throughout the organization. This broad approach recognizes that effective governance extends beyond financial controls to include operational controls, compliance controls, information technology controls, strategic risk management processes, cybersecurity arrangements, and other mechanisms designed to protect organizational value. Comprehensive reporting therefore enables shareholders to understand the robustness of the organization's overall governance framework rather than focusing exclusively on accounting controls or financial reporting systems. The Audit Committee plays a particularly significant role in supporting communication between the board and shareholders regarding internal controls. As an independent committee composed of non-executive directors, the Audit Committee oversees internal control systems, reviews internal audit findings, evaluates risk management arrangements, and ensures that governance disclosures accurately reflect organizational control effectiveness. The framework notes that the annual report should explain the work of the Audit Committee, thereby providing shareholders with greater insight into how governance responsibilities have been discharged throughout the financial year. Such disclosures improve transparency by demonstrating that internal controls and risk management have received appropriate independent oversight at board level. Corporate governance also encourages direct shareholder engagement through the annual general meeting, AGM. The program highlights that the chair of the Audit Committee should be available at the AGM to answer shareholder questions relating to internal controls, governance, and risk management. This direct communication mechanism enhances accountability by allowing shareholders to seek clarification regarding governance matters and by providing independent assurance from committee members responsible for oversight of financial reporting and internal controls. Such engagement reinforces the board's accountability while strengthening investor confidence in governance processes and organizational transparency. The importance of internal control reporting has been reinforced internationally through governance reforms and legislation such as the Sarbanes-Oxley Act, SOX, in the United States. The framework notes that Sarbanes-Oxley introduced more detailed legal reporting requirements regarding internal controls, requiring management and external auditors to provide explicit assurance over the effectiveness of financial reporting controls. Although governance regimes differ internationally, the underlying principle remains consistent. Shareholders require reliable information regarding internal control effectiveness to evaluate governance quality and organizational resilience against emerging risks.